Hey everyone, Lawrence Mack here, real estate broker out of Mississauga, and I'm here joined by Christopher Lee, a financial advisor from Sun Life. How you doing, Chris?
Not too bad. How are you, Lawrence?
I'm doing awesome. We're here today to talk about mortgage insurance, and I guess the first question is, why do people need mortgage insurance?
Well, I think mortgage insurance is, one of the most important things to consider after you've purchased a property, right? Obviously, you've taken on a fairly large financial liability, and obviously, if something were to happen to you, generally people think about death, but you also have to think about, if you got sick or if you got injured, how are you going to pay that outstanding mortgage, particularly if you have a spouse or children to take care of
Yeah, for sure. So, I mean, definitely the mortgage is going to be a big chunk of money that, we're going to end up owing. I remember when I first got a mortgage, when I first bought a house, the bank basically put in an automatic, mortgage protection or something like that. What do you think about that product? Like, I was actually surprised that they put it in there, and I told them to take it off and found some other method to protect myself. But like, what do you think about that particular product from the
I
bank?
mean, I think it's natural for for a lender to want to kind of slip that in as you're getting
Yeah,
your mortgage because frankly, funny enough, they're protecting their liability there because they want to make sure that, hey, you know what, if unfortunately something happened to you,
you're right.
they're going to get their money back. So in a sense, I understand where they're coming from, but from you as the person lending, or sorry, as the person borrowing the money, I think it's important that you have to cover, not only the situation where if you were to pass away, but like I was saying before, is if you became disabled,
Mhm.
if you became injured, or if you became sick, but you haven't passed away, but you still have this liability that you still need to manage. So that's why I feel like, with a lot of our clients, when we first engage and work with them, they're always talking about the mortgage insurance that the lender has proposed. But we want to look at it from a more holistic perspective in that, okay, obviously life insurance component is very important, but you also want to protect, in my opinion, the most important asset of anybody, which is frankly not their house, nor is it their investment portfolio, but it's really their ability to earn, their ability to bring income into the family. Because like I said, if you were disabled, you still have that mortgage that you have to manage, but now you may not be bringing in the same amount of income or no income at all. So we always suggest to our clients, first of all, if you're lucky enough to have, benefits or group benefits from your employer, you really want to look at that to see whether or not, one, they cover, disability, whether it be short term and particularly long term, and whether or not they have, some sort of protection against critical illness. And then we would always say, hey, you know what, if you don't have that, then it's probably a good idea to look at, outside sources to get personal insurance on this or to cover your disability or your critical illness just in case something happens to you.
Right. And is it true that for a lot of the mortgage insurance, at least from the financial institutions, the beneficiary would be like for the bank?
Yeah, absolutely. Again, the banks are they're always trying to protect themselves, right? And again,
Right.
I understand that from a business perspective, but you're absolutely correct. And that's why, for our clients, we always say, hey, you know what, before you sign on the dotted line for that mortgage insurance through the lender, you may want to kind of take a step back because if you were to pass away, God forbid, and you get this lump sum of death benefit proceeds, the bank is automatically the beneficiary. So you have absolutely no control with respect to how to use that lump sum. However, if you got life insurance outside of the context of creditor insurance or the mortgage insurance, then what happens is that puts the control back into your hands. Because if you got that lump sum of tax-free proceeds, you get to decide, okay, how do I want to use this? If you wanted to pay down the mortgage completely, by all means, you can do that. But I would say that a large majority of people may not want to do that because they can take those proceeds and they can continue to pay the monthly mortgage that they're used to and slowly kind of chip down in that lump sum of money. But they also may have kids. They may have young kids. So in that scenario, they may want to take a little bit of that money and use it to put it into the RSPs, help with daycare costs and whatnot. So again, that flexibility puts control kind of back into your hands to decide how you want to use that lump sum, right? And just other things to really kind of consider with respect to that is if you get this lump sum, you can always take it and you can invest the money as well. right? And if you invest properly with that, you may end up getting a rate of return where you can use that rate of return and use it again to maybe help with the mortgage payments, because there's a good chance you're probably, as a surviving spouse still working, then you can use that additional income coming in from the investment proceeds to essentially kind of supplement the lost income due to your spouse passing away.
Oh, that makes a lot of sense. So really, I mean, if you take the default mortgage insurance from the bank, that would just pay off the mortgage, but really you want more flexibility in terms of if you have a lump sum payment, because you don't know what you want to do with it.
Exactly. And another thing that, I would add to that is, and I'm not going to, use this as a blanket statement, but generally when you get that mortgage insurance through the lender, you're automatically approved. And that may be great, frankly, if you've had, previous or prior medical, situation where it may, where it may prevent you from getting life insurance elsewhere. But generally, if you went to any insurance company and you apply for life insurance individually, you have to go through what's known as underwriting. Essentially, they, as part of the application, they kind of take a look at your health history and see, what your health situation is like, and then they will essentially quote you based on that. So why that's beneficial is if you happen to be a very healthy individual, frankly, the cost of getting an insurance policy outside of a lender's mortgage insurance probably would cost significantly less. And not to mention, a lot of times with mortgage insurance through the lender is the rates are going to be what's known as banded, as in after 5 years, after 10 years, whatever that may be, it's going to increase in cost. But a lot of times, the most cost-effective life insurance strategies out there is known as term insurance. And you can get the terms for 10 years, 20 years, 30 years. And what that simply means is that that insurance cost will never increase. It'll always stay the same.
If I try to protect myself for my mortgage, what are the different types of products I could use to protect myself against, something bad happening, whether it's disability or life or that kind of thing?
Oh, absolutely. So, like I was just talking about before, the life, covering, the situation where you pass away prematurely, then definitely life insurance, right? That's going to be your best friend. And like I said, term insurance is generally the most cost-effective way to do that. Usually what we would suggest to clients, again, it's different for everybody, but generally what I would say is simply match it with respect to what your mortgage term is, right? So generally people probably have a 25-year mortgage, and then in which case then you can just look at the term 20. And there's a lot of flexibility with the term insurance because for the clients who are aggressively paying off their mortgage, maybe after 10 years, their need is no longer, hypothetically a mortgage of $1 million. Maybe after 10 years of aggressive, repayments, now it's only down to 500. So at that time, if the client so chooses, they can reduce the amount of term insurance and save themselves a little bit of money as well. And then with respect to, okay, you know what, you haven't passed away, great, but you are injured or you do, you get ill, then what I would always suggest is definitely on the disability side. Again, if you don't have coverage through your work, then definitely you want to look at doing, putting in place a disability insurance policy. And simply what that does is if you were to become disabled for a consecutive amount of time, then what happens is the insurance policy would pay you out a monthly income. Right. So, another way to call disability insurance is essentially income replacement. Right. Naturally, it's not going to be the exact same amount that, you used to be paid, because obviously then there's no incentive to come back to work. Right. Because the idea is rehabilitation. It's not, hey, we're going to give you money for the rest of your life.
Right.
But again, it will definitely help rather than having no money. Even having, 2/3 of what your income used to be, that's going to be a significant help with respect to managing your family finances. Outside of disability, then the other bigger one I would say is critical illness. So in a nutshell, what that simply means is if you were afflicted with, a critical illness, so things like, heart attack, cancer, stroke, and, fortunately you didn't pass away, but you did have that medical condition, what happens is the policy simply pays out a lump sum of money. So again, this lump sum, tax-free, you get to decide how you want to use that money. Again, whether it be to pay a big chunk of the mortgage down or to, again, kind of strategically manage your cash flow so that that lump sum that you receive is spread out over, 5 years, 10 years, whatever may be the case.
Okay, well, I think that about covers it. So basically, your mortgage is a massive amount of debt that you may have to pay if something
Yeah.
happens, and so you definitely should look at it. By default, the bank will give you something probably. You should take a look to see what you're paying there and what you're getting covered with. Alternatively, you can talk with Chris on some type of products to see how it might protect you, whether it's either term life or disability or critical illness. All those are very good options depending on what it is you're trying to protect against.
Exactly.
Sounds good. Chris, how can people reach out to you?
Yeah, absolutely. So you can always call me or text me, up to you. My phone number, 647-834-4675. Or if you prefer email, my email is chris.lee@sunlife.com. Or finally, I don't use a lot of social media, but I do use LinkedIn quite a lot. So if you search Christopher Lee on LinkedIn, you'll definitely find me there.
Sounds great. That's awesome. So again, I'm Lawrence Mack, Mississauga broker, and that's Chris Lee, financial advisor from Sun Life. Thanks, everyone. Bye.
Thanks, folks.